Hi, this is Matt McAleer, Director of Equity Strategies at Cumberland Advisors. Just past the close of business on February 15th. Good strong week in the land of equities, both domestically and internationally. We're going to rotate back to domestic in a moment. On the international side, it was nice to see Europe finally get that bid we talked about last week. If that bid can continue, we may be in line for a decent 3-6 month run internationally, because we have been pleased with how Asia's traded in Latin America. So good to see the developed markets taking part in this move. On the fixed income side, John was with me last week talking about the 267, 268 10-year bond in relation to 10 basis points on the 10-year German bond. Still the same type of thing. Not too much movement in interest rates this week. Let's spend the next couple of minutes talking about the U.S. portfolio and some changes we've made in there and some history of what may have caused us to start making those changes. About 18 months ago, we started to back off our large cap allocation. We were about 80% large cap, 20% small and mid. Today we've gotten down to about 60% large cap, 40% small and mid. Why are we doing that? Why not just buy the S&P 500 or some large cap indexes? That seems to be what's working. That's what recent activity has shown us. We started to make that both on a valuation standpoint and recently on some relative strength changes that I want to talk about. I had Shay run some Bloomberg numbers for me this morning, trying to compare MDY, the mid-cap 400, to SPY, the S&P 500, over the past periods of 1, 5, 10, and 20 years, to try to get an idea of how much of this large cap bias has crimped our returns as we started making that change 18 months ago. I want to share some numbers with you that I think you'll find fascinating, and then we'll talk a little bit about that tilt we've started to do away from large cap. Over the last year, S&P 500 has outperformed MDY, mid-cap 400, by 2.4%. We've seen that, we felt it, it's been tricky. That includes the fact that MDY right now, year to date, is outperforming the SPY by 400 basis points, or 4%. Real nice relative strength. If we go back 2 years, you start getting into some ugly numbers if you're a mid-cap fan. S&P 500's outperformed MDY by almost 12%. Tough to overcome that kind of relative weakness in mid-caps versus large caps. We go to the 5-year number. SPY has outperformed MDY, the mid-cap 400, by over 18%. 18%. That's a ton of performance just owning the S&P 500. Why own anything else? Important to get that market cap question right. Also, impossible to time it perfectly. They don't ring a bell and have you move from large cap to mid cap in either stages or completely. But you do have to look at relative strength and some indicators that start to show demand coming into asset class size. If you can get asset class size and style, large versus value, right, that's 75-80% of the battle. Sectors and industries are important, but the markets are often dominated by cap size and style size. When we go to 10 years, we start to see a change. Going back to February of 2009 through this morning, MDY has outperformed SPY by almost 17%. That surprised many people in the office. We have such a recency bias on S&P outperformance that it's almost ingrained in our heads. The real fascinating number is when we go back 20 years. When we go back to February of 99 through this morning at 10:30, I had to have Shay run it 2 or 3 times because I couldn't believe the number. I remember small and mid cap being strong. I remember the outperformance. in the early 2000s, especially coming out of 01, 02, where the NASDAQ got hit hard, down about 75% from peak to trough. But the number startled me. Going back 20 years, MDY has had a total return of 505% versus the S&P 500 through SPY of 205%. What that equates to is a 9.5% or a 9.41% annual return in MDY and a 5.73% annual return in SPY. What that also shows you is the power of compounding. That performance gap of 4% or so annually compounded adds up to a 300% difference in performance. Goes back to making sure that you're paying an awful lot of attention to cap weighting, and sometimes trying to lean in against recency bias. We read it everywhere. We hear it everywhere. S&P 500, S&P 500. Why own anything else? Well, going back 20 years, there was a real strong reason to look around. We've seen some relative strength start to change in both small cap and mid. We've tilted our portfolio that way. We were early. Sometimes they say if you're too early, you're wrong. Fortunately, we're trying to take more than a quarter, a 6-month, a 12-month view here. We think that 40% small and mid going out 2, 3, 5 years can really compound and give us some performance over our benchmark, which is the S&P 500. Keep in mind, bond markets, stock markets close Monday. If anyone has any thoughts, ideas, comments, feel free to email us. Norm, our crackerjack cameraman, is going to have charts up that go over these relationships in the weekend package. Everyone have a great weekend. See you next week.